Do I think Lockheed Martin shares are still undervalued? The answer is hey everybody, and welcome back to H Invests. So, Lockheed Martin, a high quality global defense contractor. Amazing company, but are the shares overvalued or are they undervalued and still a good buy? A few weeks ago, I did a full stock analysis on Lockheed Martin. Since then, the shares have gone up about 6%. And today, I wanted to give a little bit more light on their valuation. We can go through it in detail and work out if they're still a good buy at current market prices. I hope you guys enjoy. Okay, so let's get started with this DCF. So you can see the current share price, $358, currently on the 19th of March. And let's start with the free cash flow past and the projected growth. So you can see the free cash flow for Lockheed Martin growing over time. This is a pretty stable uptrend. You do have an outlier in 2018. This was actually due to a massive tax bill that Lockheed Martin had to pay. It wasn't anything to do with their actual operating profit. So this was a one-off reduction in their free cash flow. So if we follow this long-term trend up, the free cash flow's annualized growth is about 11%, calculating it like that. And then if you look at analysts' forecast for the future, the median of the forecast is growing at about 4.42%. So we're not seeing quite the same growth that we did in the past, but we're still seeing growth nonetheless. And then we have our discount rate. So I use WACC to get a basic discount rate. That came out at about 7.5%. The reason that that's quite low is because Lockheed Martin's low beta was pulling it down, right? So they're the US defense contractor. They have long-term stable revenues. Therefore, the share price is not usually that volatile. So that gives us a lower discount rate. And then we've got a long-run growth rate of 2.5%. So after the 5 years that we're forecasting, we think that Lockheed Martin is going to grow at 2.5%, which I think is a reasonable estimate because that's in line with long-run US GDP growth, and Lockheed Martin make most of their revenue and profit in the US. So if we go purely off these analyst numbers, 4.4% growth every year at a 7.5% discount rate, using all of the other inputs, we get an implied value of $474. So Lockheed Martin is looking very, very cheap at the moment if we use these metrics on 32% upside. But what I like to do as well is I like to build these matrices where you can effectively see what Lockheed Martin's intrinsic value would be at different growth rates and at different discount rates. So you can see the free cash flow growth on the X and then the discount rate on the Y. I've gone all the way from 0 to 10. I didn't go less than 0 because I have high conviction that Lockheed Martin is going to grow. It has long-term contracts with the government and they've got so many innovative areas. I think we're definitely going to see at least 0. And then I put all the way up to 10 because, the analysts are forecasting 4.42. I thought this was, obviously it's a lot lower than what we've seen in the past, so I put 10 up there just to see some optimistic numbers. And then this box that I created, that's where my personal most likely scenarios would be. So I think between 4 and 6% is about right. Analysts think 4.5. They've grown at 11 in the past, so I think between 4 and 6 is reasonable. And then you can see the discount rate. I think certainly for a company like Lockheed Martin, between 7 and 8% is about right. 6% is a very low discount rate for any company, given the S&P tends to return 9 or 10% a year. But given Lockheed Martin's stability, I think they deserve a lower discount rate than the average company. And WACC seems to think that as well. So looking between a 7 to 8% discount rate and a 4 to 6% growth rate, this is how much Lockheed Martin is undervalued by. And you can see the intrinsic value calculations here. So from a discount to cash flow perspective, it's looking pretty good. This is a lot of upside. And yeah, from a discount to cash flow perspective, Lockheed Martin is definitely looking undervalued. Okay, so now what we're going to do is we're going to look at Lockheed Martin's forecasted earnings per share and price to earnings to come up with a price. Effectively what we're doing here is obviously the price to earnings ratio is the price per share divided by the earnings per share. We're literally just flipping that around, right? So moving earnings per share to the other side of the equation, and then when you multiply the earnings per share and the PE together, you should get a price target. So that's exactly what we're doing here. So looking at Lockheed Martin's historical PE numbers, it doesn't look like they have that much variance. Again, we saw this outlier year. This was when they paid their massive tax bill. This is FY 2017 when they actually stated that they paid it. and then it came through to the cash flow in 2018. So that's why we're seeing it on 2017 here. So what we do is we take an average of those PEs, which is down here, but I'm taking FY17 as an outlier. So we're doing the average of those four, and that gives us an average PE of 16.8 over the last 5 years for Lockheed Martin. And then we can also look at the earnings per share growth. Again, if you kind of use this as an outlier and take the 5-year growth, then the previous growth we saw was 20%, which I think is very impressive. Analysts are forecasting these, which is looking like it's going to grow at about 7% per year over the next 3 years. So again, we're not seeing quite as high growth forecasted as we've seen previously, but we're seeing relatively good growth nonetheless. So how does this translate into the matrix? So we forecast the earnings per share, we multiply that by the price to earnings, we also discount it. For these kind of models, the discount rate doesn't play as big a factor in calculating the valuation. So what we do is we just keep the discount rate constant at 7.53%. It's much less of a factor, and it means we can build a matrix with only 2 variables instead of 3. So again, I've done the EPS growth all the way from 0 to 10. So you've got the most pessimistic scenarios over here, the most optimistic in the bottom right-hand side. And then you've got my famous box where I think the most likely scenarios are. So I've chosen a PE anywhere from 14 to 16. Obviously going down to 14 just because we did see an average PE of 14.3 in 2020. I do think the shares are undervalued then, but the market was pricing a PE of 14 nonetheless. And then 16 is kind of between 16 and 18 is where we're looking at for this long run PE. You know, it did get up to 20 at one point. It was pretty much 18 in 2019. So I think this range of PE from 14 to 18 is about reasonable for Lockheed Martin. You know, growing company, stable company, their turnover and their free cash flow growth is never going to set the world on fire. So I think a PE of about 14 to 18 is right. And then looking at the earnings per share growth, so analysts are forecasting 7. So if we use the range from 4 to 8 to be a bit more conservative, these are the valuations you get from Lockheed Martin. So again, from an earnings per share perspective, it's looking relatively good. Not quite as good as the free cash flow perspective, but still on the whole, relatively undervalued nonetheless. You haven't got quite as much upside, but on the whole, more of these sales are looking undervalued than overvalued. The most pessimistic one being a downside of 13%. And that's if you think the shares are going to grow at 4% per year with a PE of 14. If you plug in what the analysts think, so if you plug in the analyst growth, if you plug in this historic PE, and if you plug in the discount rate, then you get an implied share price of $384.37, which gives you about 7% upside on the current share price, which is okay. It's looking undervalued, but not with a huge margin of safety. Okay, and the last thing I wanted to touch on briefly was just some different analysts' estimations. So you have Morningstar. Morningstar think the shares are relatively cheap at the moment. Morningstar tend to really like companies like Lockheed Martin because Lockheed Martin have a very wide economic moat through scale advantages and switching costs. And Morningstar, they focus a lot on economic moats. Credit Suisse think Lockheed Martin is a little bit expensive at the moment. Thomson Reuters, very similar target price to Lockheed Martin. They think the shares are a good deal. Seeking Alpha, so that they basically forecast average analyst estimates. They get all the analysts together and they kind of average the target price out. That comes out at about 15% upside at $412. And CFRA, they are really, really bullish on Lockheed Martin with 41% upside. So if you kind of average all of these analyst estimates out, you're getting an implied price of $423.13 with current upside of 18%. Okay, so in conclusion, do I think Lockheed Martin shares are still undervalued? The answer is yes, I do. If you look at my discounted cash flow models, all of the values that I'm most comfortable with are in a range of 20% upside to 60% upside. If you look at my earnings per share and price to earnings forecasts, all of the outcomes I'm most comfortable with give me a range of 13% downside to 25% upside. And if you look at what all of the analysts are thinking, you get a range of 7% downside to 41% upside with an average upside of 18%. So yes, I think the shares are still undervalued. I think we could see upside anywhere in the range of 10 to 25%, maybe 15 to 20% is where I'm most comfortable. But yeah, it's a quality company. Go check out my full stock analysis if you want a deep dive on everything fundamental to do with Lockheed Martin to give you a better idea of what they do and how the business operates. I just wanted to shed a little bit more light because in that video I went through the valuation quite quickly and a lot of people had some questions. So I hope you enjoyed the video and found my valuation useful. I've been H Invests, and until next time, happy investing.